you guys are probably wondering, what do I have to do to actually get money out of the ESOP? Again, it's a retirement plan. So that's really the intention, would be that when you retire from the company at age 65, you're eligible for a distribution. If you leave the company for any other reason, or if you die or become disabled, depending on what the reason is for your termination, that dictates the timing of when you'll receive your funds. So if you leave at normal retirement, death, or disability, payment is going to start in the plan year following the year you terminate. So let's just say, for example, that I'm 65 and I terminate this year. That means I'm going to start receiving my payment probably summertime of next year. So there's a bit of a delay as we do the accounting and we figure out what the valuation is going to be. You can receive your payment in either a lump sum or up to 5 installments. There is what we call a distribution threshold of $5,000. So any amount being paid below $5,000, we're going to pay that out in a lump sum. Anything below that, we will pay it out in installments. So we know that not everybody is going to stay to retirement age. What happens if you leave for any other reason? So we have a 30-year ESOP loan. And the IRS says if we have an ESOP loan outstanding, we can actually delay when we pay out accounts of terminated participants. The exception would be, I can't delay you any longer than the later that you attain age 65 or the 10th anniversary of your participation. So for an example, if I am 58 years old and I leave the company in a couple years, I'm not at retirement age. The ESOP will actually start paying me out on the later of 65 or my 10th anniversary. So if I'm 58, you might start paying me out when I'm 68. So we cannot delay you forever. There is also an exception for vested balances that are less than $5,000. So if I leave today because I'm moving to Kentucky and we don't have an Amigos for me to go work at, and my vested account is less than $5,000, we're going to go ahead and pay you out the year after you leave. Once you start receiving those payments, again, it's going to be either a lump sum or up to 5 installments with the same distribution threshold. So that amounts over $5,000 are going to be paid out over a period up to 5 years. So once I start receiving that distribution, you're going to get paid out cash. And either the company or the ESOP is going to buy those shares back from you. We will use the most recent valuation of the company. So if I get paid out 10 years from now, what I receive will be determined based on what the ESOP value is 10 years from now, not the value that it is today. So you've made it to retirement age. You're finally starting to receive your distribution. What can you do with that money? Well, the thing to remember is that it's a retirement account. So if you take the cash out, then that money is going to be taxed as ordinary income to you. Or you could roll it over to an IRA, which is an individual retirement account, and you can continue to defer the taxes. So as long as you keep your money within the ESOP plan, you don't pay any taxes on it. If I put money in there, you're just going to leave it alone. You're going to let it grow tax-free. So once you take that money out, if you don't choose to roll it over, if you just take the cash, you're going to be paying taxes on it. Also, if you are under age 59 and a half, the IRS is going to charge you a 10% penalty for early withdrawal. And that's not a Roger rule or a CARA rule or a BKD rule. That's an IRS rule that applies to all qualified plans. And it's really there because the IRS says, we want you to keep this money until you're ready to retire. And for that reason, we do not allow any loans from the ESOP account. So when you ultimately retire, how do we know how much is going to be in that account? I definitely can't tell you exactly what those numbers are going to look like, but we know a couple things. We know that the longer you are with the company, the more shares you're going to accumulate. We know that the higher your compensation, the longer you stay, the more raises you get, the more shares you're going to get because you're more highly compensated. And the other piece of that is going to be that stock value. Now, we talked about some stories with Houchins and Winco Foods and what those accounts look like. Those are obviously pretty exceptional success stories. But we've done a lot of research. The ESOP Association and other groups have done a lot of research to figure out what difference does the ESOP make to individual people, right? Not just what does it do for the company, but what does it do for real people like you guys sitting in the room? The answer is that on average, people who work at ESOP-owned companies have 5 to 7 times more in their retirement than people who do not work at ESOP-owned companies. Now, I don't work in an ESOP company. I save my own money for retirement. And I think about how much I save and how hard it is to make yourself sometimes save that money when you could spend it on something fun, and how much I have. And I think, well, gosh, if I could multiply that by 5 to 7 times without having to put any of my own money into it, how fantastic is that? That's a really unique opportunity that you guys have. But a lot of it will be driven based on what you guys put into it, as both individuals, but also as teams.